Welcome to our Equity Market Outlook. I'm Pavitra, and today we are going to discuss basically some of the key events that have taken place over the last month or so and how Mire is really looking at all of these events. I have Vrijesh Kasera with me today. Vrijesh, thanks for joining.
Thanks, Pavitra, for having me.
The events over the last month have been quite significant. So just take me through what happens when a trade deal, which is so long awaited, finally comes through. So does it change anything from an investment point of view?
Sure. So you're right, Pavitra. It's been a long awaited deal, right? So it's been more than 9 months since we have been waiting for this deal to happen. In the interim, we have had a UK deal, a European deal that got signed very recently. Now, as it has happened, the terms though are still awaited. Whatever is known that the 25% reciprocal tariff goes down to 18. The 25% punitive tariff goes away. So net, we are at around 18% tariff from a 50% overall tariff is positive for us. It places us at the lower end of the spectrum in terms of the Asian peers. Yeah, emerging basket, and so it is comparatively we are better placed. And US is our an important trading partner for us. It is roughly around 20% of our exports, right? So it helps in terms of the market sentiments as well as if you see last few months or so, a lot of things have changed, right? So we have seen the currency depreciation that has happened of around 3% in the last 3 months, 5% over the last 1 year. We have even seen FIIs inflows that have that doesn't seem to stop. Last full year we have seen a 20 billion kind of a outflow from the FIIs. Last month itself we saw roughly around $3.5 billion of FII outflows, which is phenomenal, right? So there was a lot of selling pressure in the market. With this deal now behind us, incrementally things on both these fronts should start improving. Right, so that is a positive. Secondly, if you see the export data as well, so though we haven't seen a lot of impact on the overall export growth, there has been reasonable single-digit growth on the exports, but much of it is to do with some front ending of the supplies to the US as well as some diversification by the exporters to other countries. But with the US trade deal now behind, I think we could have some fillip on the exports side as well.
But tell me which sectors where you think that fillip could really come to see, because there are, whether it's textiles, auto ancillaries, these are the sectors which have a significant export to the US.
So most of the sectors that got impacted as well, right, which were mainly labor intensive, be it, as you mentioned, textiles, gems and jewelry, auto component industries, right? So these are the sectors which were largely impacted. We export a lot of pharmaceuticals and chemicals as well, but those were largely out of the purview of the tariffs earlier as well. So that doesn't change anything from that standpoint. So these are the sectors that kind of benefit from the trade deal over a longer period of time.
With this kind of overhang lifted, the trade deal coming through after 9 months, do you think those sectors, a lot of banking, financial names, need to be extra carefully watched, considering that, FIs usually have larger positions there? I mean, I know we anyway like banking, but if there's anything else.
So, considering if you look at the FI selling that has happened over the last 1 year, even recently it has continued. Much of the, as you mentioned, much of these larger sectors, banks, oil and gas, these are sectors where IT, has been sectors which have been most impacted, right, in terms of the selling pressure. But having said that, I think the domestic inflows have kind of, helped quite a bit in terms of, stemming the flow. Having said that, I think going forward with this trade deal happening, I think the confidence in the market in terms of incremental growth that will come through, plus the valuations being where they are currently, we are trading at around 527 earnings. In terms of emerging market, if you compare, we are trading at long-term means. So in terms of valuations, we are at this point of time quite reasonable. So from their lens, it makes a lot of sense to add weights in India. But yes, we'll come to know over a period of time how it pans out.
Okay, got that. The other big news that came obviously was on the budget. The market likes to react to the immediate news, which was on STT. But if we zoom out a bit, from a long-term investment perspective, that's not the big talking point, right? There were announcements on manufacturing, defense, all of these pockets. Anything that's a big standout to you?
Much of it was announced much earlier, right? So not much was expected out of the budget. Having said that, the government did a phenomenal job, I think, in terms of maintaining the fiscal prudence part, right? So the gross fiscal deficit has been mentioned at around 4.3%, lower than what it was or it is expected to be in FY26. So according to us, there is some neutral stimulus that has been provided because the expectation was that this number would go down to around 4.2, right? So as you mentioned, there has been some impetus that has been given to defense, and there have been a lot of long-term focus or emphasis that has been laid out on sectors like manufacturing, as you mentioned, semiconductors, equipment manufacturing, component manufacturing, basically. So those are sectors that have been mentioned, and some allocations have been made to those. So on that front, I think it was a very balanced budget. The overall budget math also came out to be quite reasonable, right, with roughly around 10% kind of a nominal GDP growth, roughly around 7% kind of a gross tax revenue that the government has assumed,
Yeah.
and 8% kind of a spending growth. So all these numbers seems quite reasonable to me. So on that front, it as you mentioned, STT was a knee-jerk kind of a reaction, but longer term, the markets is a slave of earnings, and they will continuously focus on longer term. They will focus on earnings and how the trajectory would pan out going forward.
Yeah, I'm glad you brought that up because we always talk about this, right? That ultimately the market needs earnings to run, and whatever other news comes is a little bit secondary. So the earnings season has started, and you also were talking about the GST part, which is, of course, it plays out over some quarters. Have you started to see that? I saw the auto sales, which are looking quite encouraging.
So auto is one sector which has benefited quite early from the GST benefit, which can be seen from the monthly numbers as well. Over the other sectors, I think it would take its own time, right? There have been some commodity pressures in many of the sectors. Some sectors are recovering from those. So the RM basket has gone up, or has been quite volatile in many of these sectors. So it would take a little bit of while. I think the overall domestic demand has to start seeing recovery, right? But having said that, I think if you look at the earnings trajectory for the last 2 quarters, right, specifically starting Q2, Q2 was the first quarter after many quarters that we started to see earning upgrades on the overall index. We are in the midst of a earning cycle or earning season, right? And we are already, if you look at the companies who have reported numbers, of the Nifty companies, roughly around 30 companies have reported the earnings till now, and we have seen earning which have been better than estimates for roughly around 50% of the companies, and they have beaten estimates by on an average by around 3.5%. So the earning revision trajectory or the continues to remain on a positive side for the last 2 quarters, which we believe gives us more confidence for the growth next year. Considering, as you mentioned, there would be full year of GST tailwinds that would come through. We have this US issue now behind us, so that would help exporters as well to grow faster. So there is much more confidence on that mid-teen kind of a growth for FY27 and beyond, for the markets.
We've been saying this for a couple of weeks now, in fact, considering we got this big cut. And all of these things, FIs pulling out, whatever trade-related issues we saw could actually pose a good entry opportunity. And maybe when FIs return, the prices will not be this cheap, right? That's when the market tends to jump up. Vrijesh, one question that investors always want to know is where you would personally put in money now if you had to. But tell me, apart from the funds that you manage, what pockets look good to you? Where will you invest money across the funds?
With the overall sentiment improving, the earnings for the market looking better, I think mid and small cap is a space that one should look at very, very closely, considering the last year and a half, we have seen a reasonable correction in terms of multiples in that basket versus the large caps. Large caps have been quite resilient versus the small and mid caps. So this is a space that one can look at to build position over if somebody has a view of more than 2 to 3 years.
So mid and small caps is your pick. I hope that helps anyone tuning in. Vrijesh, thanks for joining us and taking us through your entire equity outlook and also narrowing it down to some funds that you like. We will be back next month and we will talk about everything that's gone down in the coming few days.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.